Hey guys, welcome to Wealth Talk. Today I'm going to talk about the hot IPO frenzy, Airbnb coming to market this week, DoorDash coming to market this week. And the big question is, at these valuations with the big pop for both of them on the first day, is now the time you want to buy into these names? Welcome to Wealth Talk. Let's talk about this IPO frenzy. We saw two huge IPOs, very successful, come to market this week. We had Airbnb, which everybody knows they had a big, challenge at the beginning of this year, but it's turned around. The company's starting to do very well. Huge opportunity ahead of it. And DoorDash now, especially what we've seen with this pandemic this year, this is a company that's actually been able to benefit from people ordering in, staying at home. And so that's a company that's actually seen its earnings accelerate because of this. So one thing we want to look at is the IPO market in general. We've talked about this before, and I always use, and I'll go back to my Amazon story. When I got into the market, the year before I started as a professional in 1997, Amazon went public. And so that was an initial public offering, priced its shares, came to market where you and I and everyone else could buy it. When it priced, the total valuation, when you add all the shares up and the price per share, which is called market capitalization, was just over, I wrote it down, $438 million valuation for the company. They had 616 employees when they came public at that time. So $436 million sounds like a pretty big company. 616 employees maybe sounds to some of you like a lot, but today, to put that in perspective, they have over 1.1 million employees, and the total market cap is 1.6 trillion with a T, trillion dollars. So that company, for early investors, when it went public and you were able to purchase it, the statistics are crazy. If you put $10,000 into it, it's worth millions and millions of dollars today. Well, it makes sense because it was a $436 million company that people thought about that day, but today over 1.5 trillion. And so the dynamics of the market at that time in the late 90s, companies used to come public because they needed to raise capital. That was the primary reason. They wanted to hire more people. They wanted to enter new markets. They wanted to acquire other companies. So they went public to get that public investor money to be able to support their growth. Well, we've talked about this time and time again. Today, the private markets are so large. There's so much money from high net worth investors that are investing in these private markets that companies are coming to market much later in their growth cycle. Companies are much larger when they come public today. So let's think about that. Airbnb, that just went public on Thursday, priced their shares at about $74 a share, I believe it was. The stock closed on Thursday right at about, I want to say, $170. What is most important about it is the market capitalization of that company was $80 billion with a B. So we talked about Amazon at 436 million, Airbnb at $80 billion. DoorDash earlier this week, the valuation on that company is $60 billion. So the companies are much larger today, and you're actually seeing in the case of Airbnb, with it going public today, you're actually seeing the growth rate, although it's still very, very high, it's growing very quick, the growth rate has actually decelerated, it's slowing down. So it's really a pretty good time if you think your DoorDash, with what's going on with the pandemic, to probably go public right now. The appetite for these IPOs has been huge. So Airbnb came to market. When you looked at the CEO who was being interviewed about his IPO, he was absolutely in shock when he heard the price that it was trading at, because he said, "Oh, 170, we just priced our latest debt round that would have put the stock at about $30 a share." So even to him, it made no sense. So what a lot of people, first you're going to hear, okay, there's a bubble in these names. The valuations are absolutely ridiculous. They make no sense. In the case of Airbnb, it's trading at 36 times revenue. So that means for every dollar it not makes, just every dollar that hits the balance sheet top line, you're paying a multiple of 36. Usually for stocks publicly traded, you just place somewhere around a multiple of 15 to 20 to earnings. So by any metric, that's very expensive. And when you look at DoorDash, it's very, very similar. What's really crazy about both of these is that people, wealthy investors in the private market, just a couple of days before you were able to purchase it, paid half of that valuation. So when it went public, they essentially doubled their money overnight. So let's talk about that. A lot of people, are saying, well, that's not really fair. I couldn't access those shares in the private market. And so the only way I had access to DoorDash or the only way I had access to Airbnb was to go out and overpay when it hit the public market. I never had an opportunity to buy at that IPO price. That's not going to change, guys. It's been that way since the first day in my career. It's like anything else. Everybody would love to pass having to go through TSA and just get onto a private jet and take off and all the comforts that come with that. But the fact of the matter is, most people cannot afford to fly private jets. So what they do is they hope to maybe fly first class, normally coach. And that's just the way it is. That's economics. And that's not going to change. So understand, if you're someone who would like to invest at the IPO price, or better, if you're someone who wants to get on the earlier private rounds and venture capital, you have to be worth a lot more money than you probably are. And that's why a lot of you listen to me now, is because you're trying to build business, or you're doing things in your career to where you become that esteemed high net worth investor that all these institutions are going after, to be able to offer you these types of deals. We're working on some things now with our firm to be able to become more active in the private equity markets, more active in the venture capital markets, to bring these types of deals to our ultra high net worth clientele. Notice I said ultra high net worth clientele. This is not going to be distributed to people who are investing 100 or two or $300,000. That's why you're listening to me. Those people that now are only investing 100 or 200, 300,000, you're listening because we want to get you to become that ultra high net worth investor. In the meantime, though, what do? What are we going to do when the stock doubles overnight? So a lot of people, including me, are going to tell you that it's overvalued. It is overvalued. Now, one thing to keep in mind, though, in the case of Airbnb, and why do I say it's overvalued? Well, when you look at it compared to another technology that's disruptive, that has an even larger total addressable market in Uber, for Uber, even though that's expensive, you're paying 10 times revenue. So for Airbnb at 36 times revenue, that's just crazy. Now, is this a company that down the line, though, could double, triple, quadruple? Absolutely. I think it's a very good company. I don't personally own any at the right price. Absolutely, I would buy some. I'm not buying any here. You have to make your own decision. And let's look at something like Lyft, for example. Lyft, another large market, total addressable market, very large, good opportunity, household name. Probably actually more people listening to this have taken a Lyft than they have used an Airbnb. That went public 2 years ago. The first day popped, hit about 70 something dollars a share. 2 years later, the stock's not even back to 50. Now, can that stock be worth 100, 200, or 300 down the line? Absolutely, it can. But what I'm trying to point out is that a lot of times these first day pops are short lived and you get a big dip. And so, as an investor, what you want to be cognizant of is that there's a lot of things, lockup periods, short term investors trying to get out of this, that there's going to put pressure on this stock probably over the next several months. And there could be an opportunity, just like with Lyft, to buy it at a significantly lower price. So, what I would say for those of you, if you really do like Airbnb, and I think we can go on for a while to say why it has a positive future, either one or two things. You have to be willing to overpay for the company, And that's what you're doing. You're overpaying. And in my view, when I did my own analysis, it's just too much for me to overpay and wait for the earnings to grow into that. And hopefully that comes down the line, or put it on your shopping list. And at some point in time, when it hits that valuation where you believe now the risk reward makes more sense, that's the time you buy it. And that's what I believe, because even when you're an ultra high net worth investor, you're not going to have access to every deal. So there might be times where you do buy in the secondary market, but it's really about that price you pay and what you want your own risk reward to be. So what I want to tell you about both of these companies, DoorDash, Airbnb, good companies. I would say I lean more towards Airbnb because I think they've dominated, have a more dominant position. When you think about who their competition is, maybe you think of VRBO, but there's not really a lot else. They've really become a market leader, and first mover advantage is very important. You think about Google and what they did with search. Well, there's other search engines, has been other search engines. You're probably using Google and you're probably not using Bing. You're probably not using Yahoo search, Lycos search, all these other ones that went out of business. So I see Airbnb, in my view, on the qualitative analysis that we did, strategically being a better fit versus DoorDash. You think of Seamless, you think of Postmates, you think of Grubhub. There's already a lot of competition there, so there's going to be consolidation. I don't really get quite as excited about that company, especially at a $60 billion valuation. Remember, Uber is only at a $90 billion valuation, much larger total addressable market. So I think in the case of both of those companies, for me, in the analysis I did, too expensive right now. Longer term, I tend to lead more towards Airbnb, but I'm not willing to pay this price for it. Now, that doesn't, last thing I want to get across, does not mean it's not a good company. I hear this all the time from people. Well, it's a good company. It's a really good company. Yeah, it's a great company, but the question is, when you're investing in that company, is it great at any cost? You know, a lot of you probably would agree that Rolex makes a pretty good watch. Like, I like Rolex watches. I think it's a great watch. They hold their value. They look nice. This is a Yachtmaster 2. It's about a $50,000 watch. And, maybe if there's scarcity out there, and there has been some scarcity in, higher end watches, are you willing to pay $55,000, $60,000 for that watch? Potentially. But what if I want to sell you this one at 200,000? Are you willing to pay that for it? Probably not, right? Because even though it's a great watch, it's not great at any price. And so when you think about that, there's a lot of good companies, a lot of great companies, but that doesn't make them great stocks. It really makes them a great stock when they're a great company, have great forward prospects, and they're at a great price. So in summarizing, the IPO market of today is definitely different from yesterday. If you ever really want to be able to get in on those deals at early stages, you can, but you have to continue to work on growing your net worth, which usually comes ways outside of just stock investing. Stock investing and getting access to these types of deals is usually the result of investing in yourself, starting businesses and making money outside that then leads to other opportunities. But if you're going to invest in today's IPO market, I think the lesson over the last few years has really been, don't forget about it. Don't say Airbnb, I'm never going to touch it, but be a little bit patient, wait and see for pullbacks, because there will be pullbacks, and then incrementally add to it. Because just remember, guys, the people with money just bought the stock a day ago for half the price that you're going to pay for it. So if you go into it paying twice the valuation, and when you hear the CEO even being shocked at the price that it's trading at, probably not the best thing to do. But I'm not going to be the one to tell you don't touch these things, because they are good companies and they could be significantly, significantly higher than what they are today, even at these prices 10 years from now. But you have to be patient and wait for that. And or, like I said, in the short run, wait for some of these pullbacks as these IPOs come out. Take a look and see which ones you really want to be invested in. Don't get discouraged. Don't be greedy. Don't hear about all the other people that are getting in at the IPO price and you're upset because you didn't, because you can get there. And that's why you're listening to me. That's why you're doing other things to improve yourself. But in the short run, if you want to own these companies, do your homework, be patient, and be a smart investor. That's Wealth Talk for this week. I'm Rob Luna. If you like the information, please tell a friend, subscribe to the channel. We put new content out every Friday. If you haven't subscribed, subscribe below, hit the bell. You'll be informed when there's new content. Thanks and have a great week.